Welcome to the Balancing Act podcast with SingerLewak, and thank you for joining us in the second installment of the International Business Insight series, where we provide expert perspectives on navigating the global business and tax landscape. In this second episode of the series, we cover transfer pricing, a vital topic in international tax compliance and planning. Today's discussion features Robin Park, International Practice Leader at SingerLewak. Robin brings extensive experience in guiding multinational clients through the complexities of international tax and transfer pricing strategies. We are also joined by Amit Maheshwari, tax partner at AKM Global, where he leads the international tax practice. Amit has been recognized as transfer pricing expert by the Expert Guides published by Legal Media Group, and as tax controversy leader by World Tax. Together, Robin and Amit will explore the fundamentals of transfer pricing, its regulatory framework, and practical strategies for businesses. Let's get started.
Welcome, and thank you again for joining the second installment of SingerLewak's International Business Insights podcast. And I have a very special guest today to talk about transfer pricing, Amit Maheshwari.
Thanks, Robin. Hi, good morning, good evening to all of you, depending on where you are. My name is Amit, and I'm the managing partner and tax partner of AKM Global. We are a 650 people firm. And over the last 16 years of my professional career, I have advised multinationals from all countries across the globe and from all sort of industries. And once you practice international tax, I think you very quickly realize that transfer pricing is the backbone of how transaction happens between various companies comprising in an M&E group. So this has led me to specialize in transfer pricing.
You know, in a nutshell, transfer pricing is aimed at putting related party transactions or interconnected transactions on the same parity as though you're dealing with unrelated or independent companies or enterprises. So, for example, if you were in the business of selling widgets, you wouldn't sell to your unrelated customers at cost or at below cost, because at that point, you would always be breaking even or be operating in the red and losing money. And at that point, why would you even engage in that business? So what transfer pricing is really aimed at is making sure, again, that related party transactions are at arm's length, so that when you are dealing with interconnected companies or your affiliates or subsidiaries, that the pricing on whatever the underlying transaction is, as Amit said, whether it's a sale of tangible property, licensing of IP, provision of services, those are all priced at an arm's length matter or principle, so that it's as though you're dealing with a unrelated party. And as Amit was saying, transfer pricing, it's a global hot button. Whichever jurisdiction you are, whether you're in the U.S., India, or any country elsewhere in the world, it is a generally a tier one issue, meaning that the tax authorities in those local jurisdictions are always interested in inquiring about a multinational's transfer pricing policies to ensure that they're complying with the principles, arm's length principles set in those jurisdictions. So, for example, in the U.S., we have a Internal Revenue Code Section 482, which governs transfer pricing, and it does follow. A lot of it is modeled off the OECD principles, which is effectively a think trust that comes up with global tax policies, and many countries adopt ultimately what the OECD standards come up with and then incorporate and tailor it specific to your jurisdictions. So again, the U.S. does follow Section 482, which governs transfer pricing. And Amit, maybe you want to comment a little bit about India and maybe some other jurisdictions you've seen as well?
The regulations in India, there is a three-tiered documentation requirement in India. You need to have a local file, master file, and CBCR. The local file is basically where we make the entire functional analysis of the entity and do a complete FAR analysis, do the economic analysis, and present a report which is to be submitted to the tax authorities on demand. Then there is master file and CBCR, which generally are required when you cross a certain threshold, and they are based on the OECD regulations. And so India has basically most of the companies, all let's say almost all the companies have to file local files. Master file and CBCR are beyond a certain threshold. The thresholds for local file in India is actually very low. And typically in an audit, that becomes the first point. So they need to have a local file, they need to see a local file in India. So the threshold for local file is only $125,000 in India, US dollars in India. Robin, that's all which I wanted to add on India.
Sure. Yeah. I mean, fortunately, I guess in a sense, the U.S. isn't as stringent in terms of a requirement to submit your transfer pricing documentation to the IRS, unless obviously you're audited. Depending on the level of documentation, you can take a position. For example, if you prepare, let's say, a transfer pricing documentation study to seek penalty protection under Section 6662 in the event the IRS were ever to audit you and then subsequently disagree with your transfer pricing, as long as that it is wrapped up in a documentation study and meet all the requirements for that, generally speaking, they will not impose the understatement penalty, which could be as high as 25%. So that is some of the value utility of U.S. taxpayers complying with 482 and engaging a firm to prepare their transfer pricing documentation study for that purpose. I also wanted to mention that transfer pricing, again, is a global issue. And, I recall when I started in this profession 20 years ago, I just think how much transfer pricing has evolved over that time, because as Amit was mentioning, 20 years ago, a lot of companies were just incentivized to shift any profits to a low tax affiliate or associated enterprise that was set up in a low tax jurisdiction, for the obvious reasons. And now that is much more difficult to do, because now the economics really have to align with the allocation of your profits. And as Amit mentioned, a very critical concept is called the functions, asset and risk profile of the entities. So basically, the more functions and risk the entities bear, then economically speaking, they should be entitled to more of the profits being allocated. And this is something that, again, I think globally, all of the tax authorities are really taking a closer look at the functions and assets and risk profile of entities to see that the allocation of profits are done appropriately and within the guidelines established within their respective jurisdictions. And if they meet the larger thresholds under the CBC reporting and master local file requirements. So in my experience, the evolution of transfer pricing has changed dramatically since when I first started 20 years ago. And so with that said, maybe we can talk a little bit about, transfer pricing as a proactive means in terms of a tax planning strategy and a way to repatriate cash in a tax efficient manner. And because, I mean, there still are opportunities in that regards, but you still have to make sure that you are complying with all the requirements and the functions and asset and risk profile aligns economically with the allocation of profits. And so with that, maybe Amit, do you want to speak a little bit about transfer pricing as a kind of a proactive tax planning mechanism and repatriation mechanism?
Yes, I think the way it works practically with almost all our clients is that when they approach us, they really need guidance on how best should the transaction be done, on how should they set up the price. The testing of the price happens when you have the compliance obligation. But before that, I think for any new setup or company looking to start business in a new jurisdiction, the first thing they ask is that how do we really set up the price? And that's where the opportunity lies. If you can look into the entire supply chain optimize it, see depending on how much substance is there, what actual functions happen. If you can innovatively categorize those functions or redefine the supply chain, there are opportunities where your group tax cost could get minimized to a certain extent. Now, when you do that, obviously, any delta increase in your decrease in your group tax cost directly adds to your profitability, distributable profits, which leads to better cash repatriations. In certain jurisdictions, due to various regulatory requirements, also there could be issues in terms of cash repatriations. To overcome that or to keep that in a line, transfer pricing also plays a lot of role. So you have to juggle two aspects. You might be okay from a transfer pricing perspective, then you might fall foul of the regulatory constraints posed by other regulations. So, classic example in Indian context was royalties several years back, where India had put up a cap under our exchange control regulations, beyond which royalties could not be paid to the parent entities. So even though your 20% royalty could have been backed up by a robust transfer pricing study, the regulations never allowed it. And because the regulation capped it at 8%, because everyone wants to exceed that but cannot do that. So you need to make sure that transfer pricing marries into your other regulatory aspect and other competing taxes. Again, classic example of customs duty. So again, just to highlight how important transfer pricing is, and then like Robin said, if you do it proactively, you can make sure that your tax costs are optimized, not only the income direct taxes on transfer pricing, but also the in this example the indirect taxes, which comprise of customs duty.
Yep, no, that's a great point. I mean, that's also a big area I've seen clients is transfer pricing in connection with indirect taxes, as you mentioned, customs and duties, and making sure the transfer pricing aligns with whatever costs you are declaring. Because sometimes there can be mismatches and cause issues that then requires transfer pricing professionals to negotiate with the customs authorities. But to add on to what Amit had mentioned, other class examples of what I've seen or advised clients on ways to repatriate cash from, let's say, your subsidiaries or your affiliates in a tax efficient manner through the proactive use of transfer pricing is, say, for example, if you're in the business of selling tangible property, and you also have developed your company, your brand and trademark, which has a reputation in the marketplace. And oftentimes, if you were to break those two into two separate transactions, one where it's a sale of tangible property, and then another where it's licensing of the trademark or brand of the company, generally speaking, the sale of tangible property does not trigger any sort of withholding tax. However, if there is a license of the brand or trademark, generally speaking, there could be a withholding tax levied, by the licensee, right, or in the jurisdiction of the licensee when it pays a royalty back to the licensor. And so, one way that we were able to avoid that withholding tax is to embed the 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 licensing aspects of the brand and trademark into the buy sell pricing of the tangible property, so that there is no separate licensing and everything has been priced in or embedded into the sale of the tangible property, as one way to kind of avoid that royalty withholding tax, especially if there is no treaty in place that exempts the royalty on the license. Another simple class example of repatriating cash from your affiliate is by just simply charging a management fee. Oftentimes, when you charge a management fee out to, let's say, your local or foreign subsidiary, many jurisdictions will not impose a withholding tax on that. However, some jurisdictions will, or there might be restrictions on payment of management fees. So again, it varies or depends by jurisdiction, but that is also a possibility. So just to summarize, I mean, there is proactive ways to use transfer pricing to accomplish the tax efficient repatriation of cash from your affiliates or subsidiaries. And I know you mentioned about optimizing your supply chain, and I think that segues nicely into the next topic about the importance of transfer pricing in cross-border, mergers and acquisitions, and particularly in the context of post-acquisition integration. And so, do you want to maybe comment a little bit about that? Because I know you touched upon it about the supply chain. You want to maybe provide some insights in that regard?
Yeah. So obviously, typically when an M&A happens, the one of the major goals is definitely to cut cost and to bring in efficiencies. And when that happens, there's invariably supply chains get consolidated, or duplicacy of functions get consolidated, and because of that, costs lying across various functions tend to get aggregated, and there comes an opportunity to redistribute them through the entire supply chain, depending on which area does maximum efficiency can come in from. Some acquisitions also result in getting some subsidiaries or units with some favorable tax rates or tax jurisdictions. So that also is something which becomes an option to utilize, considering that the entire M&A in most of the countries gets blessed by the regulators or the courts to a certain extent. So, with that overall macro picture and the blessings of the court, there is opportunities to reorient the supply chain and thereby the transfer pricing when the consolidation happens. So it's a complex topic, but just like kind of giving a broad overview. Of course.
Yes. No, I agree.
Yeah.
This could probably be an entire podcast in of itself.
Right.
But no, I agree. Those are all very good points, and something to consider. So if you ever are engaged in a cross-border M&A deal, please be sure to consider transfer pricing in terms of post-acquisition integration. It is a very important process of integrating the target and can be very complex. And we strongly advise you to reach out to a transfer pricing professional if you're in that situation. So moving forward, Amit, and kind of getting towards the finish line here. Let's talk a little bit about transfer pricing deliverables, the different types of deliverables. I'll first talk about from a U.S. perspective, and maybe you can talk a little bit more broadly about India and maybe the CBC and master file, local file. So from a U.S. perspective, as I mentioned earlier, transfer pricing is governed under Section 482 of the Internal Revenue Code. And there's generally two levels of documentation a U.S. taxpayer can adopt. The first one I mentioned was a transfer pricing planning report, which can be wrapped up into a documentation study at year end and trued up to ensure that the actuals align with the planning report. And the benefit or utility of doing a full transfer pricing documentation study is that it can be used for penalty protection under, as I mentioned, Section 6662 of the Internal Revenue Code. So in the event the IRS were to subsequently come back and audit you and disagree with your transfer pricing position and make an unfavorable adjustment, they will not impose the understatement penalty. So that is, one type of documentation a U.S. taxpayer can adopt is a full transfer pricing plan report that's wrapped up into a documentation study. It is a comprehensive report. And the other is I would say, a more truncated type of transfer pricing documentation, which is really a benchmark or comparables economic analysis. So again, it's more of a truncated type of documentation that really just focuses on the economic analysis to ensure that the comparables or benchmarks you're using is at arm's length, right? But the important distinction is that with a benchmark or comparables economic analysis, that cannot be used for penalty protection against the IRS. So that is the real main distinction between the two. And I'll let Amit talk a little bit, maybe from an India perspective, and a little bit more broadly in terms of the OECD standards.
So, first of all, the compliance requirements are broadly similar in terms of the preparation of documents and filings. Just on the penalty protection side, so India has separate penalties for non-maintenance of documentation and different penalties for underreporting of income. Just making a documentation does not save you from penalties on underreporting of income, which means that if they pick it up for audit, if they find there is underreporting of income and there is an addition to the taxable income, so they will go ahead and press penalties, even if the transfer pricing documentation was already there. Rest, I think, Robin, you have covered everything. And like I mentioned earlier, we have local file, master file CBCR, and the way we make it is as per OECD standards, almost, with certain exceptions, but those are very minor. Yeah, so that's it from my side on the deliverables.
Okay, and then I think one last question. I get this a lot from clients, and I'm sure you do as well. Amit, is how often should our clients or taxpayers, update their transfer pricing documentation? And can you maybe comment on when there are big macro issues such as a recession or if we're in a booming economy?
In India, the typical practice which we follow is once every year. The authorities are okay even if you do it once in every 3 years, provided nothing material has changed in the business. But the business, as I said, are very dynamic. In India, it's best to make it every year because companies invariably would add new service lines, shut down a few service lines. It's a growing economy. But I think once in 3 years would also be sufficient, provided you keep your benchmarking or your economic analysis updated to reflect the true margins. And like you said, a macro shock, I think COVID was one of them.
Right.
Last couple of years were very good for the Indian economy. Now the Indian economy is slowing down. So if companies don't update it, they will end up paying much more taxes than what they should have been.
Yeah, no, thank you for that. I mean, I would say the U.S. is pretty similar as well. I mean, I typically advise clients if there has been no material changes to their operations or intercompany transactions, then generally, 2 to 3 years, you know, they should probably update their transfer pricing after a couple of 2 or 3 years. And obviously, if there is a big macro change in the economy, as you mentioned, COVID, was a big macro event that was a good time to recalibrate your transfer pricing, and as a result, we kind of had a little boom in the economy, and now I think I could safely say that at a macro level, we're probably seeing a slowdown and maybe even getting into a recession here. So clients should maybe consider reevaluating the transfer pricing, even if their operations hasn't changed, but just due to the macro considerations of a global slowdown or global recession, now might be a good time to, again, recalibrate your transfer pricing. Well, Amit, thank you again so much. Truly appreciate your knowledge, expertise in this area of transfer pricing. And obviously, I sincerely enjoy collaborating with you and your firm on international tax transfer pricing matters, and look forward to continue to do that. So thank you, everyone. And we all wish you a great day and hope to see you again next time in our next podcast.
Thank you. Thanks, Robin. Thank you for the opportunity. Thanks to all the listeners to this podcast. Thank you.
Thank you for joining this segment of the International Business Insights podcast series, where we explored transfer pricing and its impact on international business. SingerLewak is here to assist you with any international business questions. Whether you're contemplating expanding your business beyond the United States or are already experienced in international markets but have new or unresolved inquiries about operating abroad, we are ready to help. Don't miss our December episode where we'll cover remediation options for international tax compliance. We'll discuss strategies for addressing missed filings, including IRS programs designed to help taxpayers avoid penalties and maintain compliance. Until then, stay informed and stay ahead. See you next time on the Balancing Act podcast with SingerLewak.